with me Arjun Paliwal, who is the CEO of InvestorKit, who are award-winning researchers and buyers agents. They specialise in helping property investors scale and grow and diversify their investment portfolios in residential and commercial property. They are also the winner of the Real Estate Business Rising Star Award for 2020. And we have our head of research, Arjun Paliwal, with us today. And for you that want to participate in this question and answers, we do have an option for you on Slido. If you go to hashtag GG2021, that way you can ask questions, and I've got the little device here on the table so I can see them, and hopefully we'll get time to get them in and ask Arjun ourselves. So to start with, Arjun, why should small business owners invest in property?
So for small business owners, I think the first thing they need to consider is just having multiple streams of income. We see that in some businesses from multiple shop fronts or multiple products. The same thing can just be added on with even more in terms of property in multiple streams, whether it be residential or commercial. So that's one key part. Other key parts are to do with, wealth preservation. So when it comes to wealth preservation, I feel that many small business owners focus on turnover, building out their business, the revenue keeps going up, but then with leftover, it tends to go to savings, buffers, and wealth preservation doesn't really happen in those types of fields, especially with low interest rates. So this is where real estate,
building, right?
Exactly, asset building. So where small businesses who get it right are those who are able to get that turnover, get the leftover, and then park it in wealth. And that is going to really create that legacy in the long term.
And does business owners get a competitive advantage by investing in property, or is it harder for them?
Yeah, so one of the key competitive advantages that doesn't feel like a competitive advantage at times is lending. And with regards to lending, it can often feel like, okay, it's difficult, it's tough. But what many business owners don't realize is that there's so much difference in lending policies from bank to bank. And what that does is that you'll have some banks that'll say, I need 2 years of your information. Some banks, they'll say, hey, look, you know what? We're not going to take the 2 years and the lower of the two. We're going to look at 1 year only, and we're going to see what this year's done for you. And others will go, hey, we understand documentation in business is difficult, putting all the paperwork together. What if we just perhaps have a low document loan? However, you actually increase the deposit that's required for us to give this to you. So this means that you can cater and work with banks to suit your scenario. Yeah. But I guess the main thing from it is you have choice, you have strategy, you can plan. And where someone might have a fixed salary each year, what can tend to happen is that your borrowing capacity is quite straightforward and the differences aren't massive. When you start thinking of, the person in a business, you go, hey, hold on a minute, I earned this much last year, and I'm going to reverse engineer what I need to get my next property. And I need to get it to this level. Now, whether you change business processes, whether you change how you pay yourself, margins, you start getting creative because that planning and goal setting and strategy can really come together.
And I guess that is really about building a strategy and aiming it towards many banks. There's lots of banks out there, right? And it's not just the big four that we're talking about here. So what would you say are the top 3 tips you can give business owners who are looking at starting their investment journey?
Look, the top tip, I think, is building a team. That's number one. When it comes to building a team, just like many people engage that particular small business with regards to their products and services, and use them as part of their journey, we need to, as business owners, also look at others who can help us on our wealth building journey. People like accountants, people like mortgage brokers, bankers, lawyers, conveyancers, your buyer's agent, property researchers. What this does for you is that it makes you realize that, hey, my strength is truly running a business. And so by outsourcing it to others, that's really going to help with regards to making sure you can get the best out of each professional.
Yeah, so you're really leveraging other people's expertise.
Correct. And so the second tip is all about risk management. Often as a property investor, people get caught up in the property, new versus old. They think of the feel, the look, the locations, the things that are easy to talk about. But what's often missed is actually the data. And when you're looking at the data, there's so much risk management that can be done within that. And I like to refer to data as indicators.
Yeah.
So to give you a classic example, my favorite indicator to rely on is something called inventory levels. And with inventory levels, it's a simple measure. We're taking how many listings are in a market and the current monthly sales volume average. So to give you an example, if you had 10 sales per month happening in a location, and then in that same suburb you had 30 listings, you've got 3 months of inventory, meaning hypothetically, it may take up to 3 months to sell all property in that suburb, which actually is a low level of stock. Because in Australia, when we've reviewed the data going back 25 years, we've seen that areas with 0 to 3 months of inventory show a lot of pressure. They tend to show growth because they have low stock. Then the low stock equals faster selling. Faster selling makes a vendor go, hey, hold on a minute, I don't want to discount much. So by using data, you can go, well, let me focus in on areas where the inventory level is okay, balanced, or low, and straight away, I'm likely to be in an environment where people are wanting properties, they're desiring it, there's not many around. Whereas if you're going to areas where inventory levels are 8, 9, and 10, you're saying that every month, 10 sales happen here roughly. However, there's 90 properties, 80 properties for sale. That equals an opportunity for price decline. So this is careful use of data which investors can do, and by using that, they can really manage their risk.
Yeah, so don't forget everyone, if you're on Slido, you can ask Arjun any questions that you'd like. We've got about 15 minutes left of the question and answers, so please send them through. I've got it listed here, so I can ask anything that we like. But while we're waiting, what do you think makes a good time, or is it a good time or a bad time to begin investing in real estate?
So investing in real estate in the current environment, I'll break it down to 3 parts. So there's one part which is money and or demand. The second part is confidence. And then the third part is supply. Now, I believe we've got some charts coming up. So if they're not showing up, they'll probably show up soon. And with these charts, I've got a few things that we've shared there. First is on the money side. We're seeing interest rates that are extremely low. And we used to have positive cash flow become a luxury back in the day. And now that's not really a luxury, that's kind of a norm. So many properties are giving you a rental income that's actually enough to pay interest, rates, water, landlord insurance, property management. And I'm not talking in the middle of nowhere. I'm talking, in major cities, Brisbane, Adelaide, just as an example. Yeah. So the key with money being so cheap is it's allowing many investors who are thinking of my returns to go, this is fairly low risk. And it's offering the opportunity for many home buyers to go, well, I haven't been on the market before, I've been renting. Maybe I can now consider buying. So that's what's happening on the money side. Other things on money is lending, right? So that's how cheap it is. Right now, lending is happening. It's growing. Owner-occupiers are really, really starting to flow, and they are pushing up, lending to quite high amounts. And investors are now starting to actually also go through the same thing. So with regards to money, that's the key thing. And I think these charts have just shown up now. Yeah. The last part is household income and consumption. So during recessionary times, people tend to pull back a little bit. They're unsure about spending, consumption goes down. But in the chart that people can see now is savings ratios have picked up massively. Savings ratios mean there's a lot of money in offsets, a lot of money in bank accounts. So when you're talking about the fuel demand, cheap money, a lot of money in bank accounts, and also a lot of lending coming to the market, that's a clear sign for demand.
They're not really earning any money having your money in the bank account, is it? It's about
correct. Can
you invest it and make an asset out of it?
And I guess that's where it leads to the next part, which is confidence. And when it comes to confidence, I've got these next 3 charts here. The first chart is consumer sentiment. So just how are we feeling? How are we feeling about money, using money, going out there? That's improved a lot.
Well, we actually do have a question that might relate a little bit to that, but is it a buyer's market, would you say, or or a seller's market at the moment, in Sydney, for example?
I would say for 3/4 of Australia, we're actually in a seller's market at the moment. Okay. Buyers are going to find it quite difficult. And on the third chart, I'll point out to why, which is, supply. How you define a buyer's or seller's market is purely what's available and who's fighting for it. So the key to getting to that supply component is if we have a look at some of these charts, labor utilization rates, job vacancies, and advertisements. So as we get to that supply, people are feeling a lot more confident. Jobs are coming back. And as a result, people are feeling like they don't have to sell, right?
Yes.
And so now those listings aren't coming to market as much. And this is kind of where the next charts go into it. So the next charts that we've got are the three components that are really playing a key part in supply. The first part is private residential building approvals. Over the last 2 years, we've seen a really large decline in new dwelling approvals. Now, detached housing has stayed fairly consistent up and down. Recently, with the home builder, that's going to be building quite a lot. But overall supply incoming is fairly low in comparison to previous years. Let's talk about maybe 2015, 16, 17 in key parts of Sydney. The next part is loan deferrals. That was a big conversation, people talking about the banks, the pauses. We've had a massive decline, and APRA's recently released their charts just around 3 days ago, and those chart releases have seen massive declines with regards to people who took out loan deferrals, taking a pause. The majority of them have come back. And so to see the majority of them come back and go, well, not a lot of listings online, not having to sell, not forced selling, that's created the last and final chart, which is inventory. And so what we did with inventory is we essentially took the last 2 years of property listings and sales volumes data, and we saw the change. Most markets in Australia have dropped their listing levels by between 20 to 45%. So not a lot of property is where a lot of growth can come from, and this is where that seller's market is going to show itself.
Yeah, so for those of you that might not know, the seller's market means that the price is going to be higher because the sellers get to demand what they want because there's so many buyers versus sellers.
Spot on.
Excellent. Is there any other indicators, and this is one of the questions from the audience, what other indicators are there that you were referring to when you talked about inventory? So you were mentioning before about how many sales are on the market. What other things should we be looking at?
Yeah, sure. So I would say the most important 5 to 6 indicators that come to mind when assessing the market's risk are firstly inventory levels, because that just shows me relative listings to sales.
Yeah.
And if that's low, it's going to be hard to buy.
Yeah.
But what inventory levels tend to do is they also tend to decrease days on market. Because if you've got lowering supply in stock online versus sales, days on market's the second indicator. If you see a decline, you're starting to see an increase in the speed of transactions. So that's getting faster. The next things we look for are the risk of future supplies. And the inventory shows you current supply.
Yeah.
Days on market shows you the reaction to that current supply.
Which is why it's a seller's market at the moment.
Exactly.
Yeah.
And then with the future supply, what you can do is we take the last 18 months of building approvals, total them together, and then we say, what's the percentage of this total that is coming on over the next 1 to 2 years? So now you've got an incoming supply risk. And if this level tends to stay below 3%, you don't realize a big shakeup in how many new properties are being built. If this number starts to jump above 3, 4, 5, for example, if there's people in Sydney, there's some parts of the Rouse Hill region, which does have a fair bit of supply coming in. And for parts of maybe Melbourne, we've got the Wyndham Vale region, which also starts to have a bit of supply coming in. So that's the third indicator. The fourth indicator is all about rents, so vacancy rates, right? Now, if you have a property, you've got a good investment, it's got low stock, faster selling, low supply risk, that's all great, and that's your price indicators. Yeah. But what about the rent? You have to hold this property. So if you've got a low and declining vacancy rate, you can fairly say that it should not be too difficult to find a tenant. And as a result, that leads to the next indicator, which is rents. Yeah. Are they moving in the right direction? And then the last part is yield. What's your return?
Yes.
So if those 5 to 6 indicators come into the picture, your summary is now, I have low incoming supply, I have low current supply, places are selling faster, the vacancy rates are low, it's easy to find a tenant, yes. Rents are rising, and the return's healthy. So that's a great conversation to have when it comes to data.
And is that where we're at now with the rental market? is it high demand or low demand, would you say?
We've got two markets going on at the moment. So number one is our unit markets. They're performing quite poorly across most locations. So those who own units in your inner CBD, Sydney and Melbourne are a perfect example. I'm seeing case studies of many people drop $100 to $150 off in their rent per week. This is a big example of that exodus that's been happening, people moving out. Right now, people are questioning A, their location of where they work and live, but B, do they also want to be in those congested areas? Now, that's not going to last forever, because what makes a developer keep building new units if they see that trend happening? So that may slow down a little bit, and we've seen declines in building approvals for units, high rises. So I feel that that's the pain point. In terms of good markets, some of our capital cities and in our regional cities are seeing a rental crisis. Now, that has two parts to it. The good part is investors, you'll be able to rise rents, you'll be able to find tenants extremely quickly, first week, worst case second week. If I'd be surprised if in Adelaide, as an example, you take longer than 1 week to find a tenant.
Wow.
That's how strong it is. However, the negative of a rental crisis is that there are stories of people all over Australia getting into caravans to live for the next few months, simply because they've missed out on properties again and again and again. So the downside is we will see displacement of many people in the housing market.
Yeah, wow. And maybe that could be a choice for travel. I've heard a few people looking at doing that. What about residential versus commercial? So obviously we're seeing this rental crisis happening in residential, but how does that affect the commercial market? And is maybe if someone's looking at investing, should they be looking at commercial versus residential? Yeah,
look, great question. I think when it comes to commercial investing, if you're considering that in your portfolio, I truly believe that you have to have a hedge. And so to me, a hedge looks like a healthy amount of residential properties, so you can feel like I'm going to take more risk, but also generate more income rewards. So for me to take that, I want that fallback of knowing I've got multiple residential properties in my portfolio. And the reasons behind that is that whilst, yes, you will get higher income, longer leases, you can also get longer vacancy. But in terms of commercial, if you're acting on it with a portfolio of properties, that will help you. But the main thing right now is industrial and medical assets are on fire.
Oh, wow.
So those assets are seeing prices increase. Those assets are seeing rents decline, rental yields decline. And right now, take for example, ANZ out there is giving interest rates with a 2 in front on a commercial property where you're getting net returns with a 6 or 7 in front. Wow. You're practically having your tenant pay your mortgage off for you in half the time it would take the loan term.
Right.
So that's huge, but on the downside, we have a lot of distressed tenants in some of the retail space. Office leases, people are taking 6-9 months breaks to be able to pay rent. So I'm not going to pretend it's all rosy. There are sectors of the commercial where it is considered high risk.
Yeah, and there's always risk where there's reward.
Yeah.
Right. So I guess that's why a strategy is really important, and to see where you are specifically at in your own journey before making these decisions. But we do have a great question, and I guess this comes up for very new investors. They want to know versus new builds versus existing builds, and the issues that we've had and we've seen with units. And obviously there's a lot of units coming on in the market, like we were talking about developers probably trying to get rid of things in the city potentially, in the main places. What's your advice along those? Are they a good investment?
To be brutally honest, my thoughts are that units are not a good investment right now, and new properties are proven to underperform against established properties. So if I talk about units as a market right now, if someone is looking at a unit and perhaps they're sitting in Sydney and they see, wow, all these prices are $1 million or 1.1, and I see this great unit for 450, 500, 600, the only reason you're gravitating towards that as an investor is simply because you're not aware of options in other cities.
Yeah.
Had you realized that, hey, in Brisbane, Adelaide, regional markets across the country, which have actually more than doubled some of our capital city performances, houses are available in 400, 500, 600,000. As an investor, being close to you, being new, being shiny, located near a train station, and these factors don't make your performance any better. It's always going to come down to relative supply and demand, and the supply is a big issue. And the demand is also a big issue in the unit spaces. So if you're considering a unit because I can't have that budget, it's not your fault. It's just that you're not thinking of having perhaps a team on your side to support you with properties outside of the place. So that's the unit part. As for new versus old, there is a lot of pros and cons to both. However, if your goal is absolutely focused on performance, when you factor in buffers for maintenance, when you factor in the risk of supply on the new, when you factor in even depreciation benefits on the new, the rate of land price growth in established areas has outperformed new areas.
Wow.
So as a result, if you're trying to make a best data-driven decision, when there's a new estate that comes up, I can't tell you how many investors are going to be there. I can't tell you how many owner-occupiers are going to be there. I can't tell you what the demographics like. That is being built. So you're not really making a data-driven decision. You're making a decision on, I saw X project.
Yeah.
I hope it will grow my portfolio. So,
and often, I guess, people are led by the marketing. You know, you hear dual occupancy and double rent, and it all sounds really good. But I guess from what you're saying, you need to have a strategy and understand where you best sit. And making those decisions, you know, a lot of people do want to buy close to them so they can visit their property. You know, I hear stories of people wanting to buy property in areas where they want to retire to. So it's very much an emotional decision. What do you say to your clients that are making those emotional decisions?
So I would say that, you know, I would be lying if I said property is not emotional, right? Even when you're investing, a little bit of emotion comes into it, right? The feel, the look, no one can completely turn off and just look at the numbers. But what I can say is that if you were to look over the last 20 years, over the last 1 to 2 years, your regional markets have been the best performers. No question about that. Over the last 5 years, Hobart being the best performer. Between 2012 and 2017, it was led by capital cities, Sydney and Melbourne. And then during 2000 to 2010, we saw markets like Brisbane, Adelaide, and Perth and Darwin completely outperform some of the others. So just in a span of 20 years, had you kept going with the what feels good, what's close to me, you would have had opportunity cost. You would have missed out on markets to capitalize on movements in Brisbane, Adelaide, Sydney, Melbourne, Hobart, regional Australia. So to me, I feel that you're only hurting yourself by feeling it, being close to it. If you're going to truly make the best investment decision, it's properties that are actually not close to you that are likely to give you the best opportunities.
And I guess it's about looking at the numbers and understanding the stats and all these other indicators that you were referring to previously. We have a question here, and I think it's interesting because, you know, property is a risk. But someone has asked about investing in mining cities and what are the risks that they're taking when they do that?
Yeah, so when you look at the risks of a mining city, there are good and bad times. But the truth about data in Australia suggests that all our cities are actually somewhat volatile. If you think of just our major markets, Sydney, we talk about jobs, population, the feel good, the infrastructure, the nightlife, whatever it may be. But we saw declines of 15 to 20% in some suburbs over 2 years during 17 to 19. We saw increases of 50 to 60% before that. And then during 2005 to 2010, we saw flat periods for close to 4 or 5 years. So it's fair to say that data-wise, all our cities have some portion of volatility in them. But if you're talking about mining towns now, most of them have an extreme sense of volatility. And that's just where I don't feel comfortable, because then, you know, your rents can drastically change, your prices can drastically change. If you can get in and you have that gut in you to get out, sure, I'm sure you can make a lot of good money from it, but most don't know that time to get out, and as a result get stung. Yeah. So I feel there's so many markets across Australia that I named as an example that have performed over the last 20 years. Why do you have to suddenly go for gold for this one moment that you think will boom over the next 2, when over the last 20 years we've seen an array of diversified towns and cities that have done well?
Yeah, and your risk is really tied into the mining industries that are in there too, so you don't really want to do that because you're leveraging off a business rather than your own knowledge and what's out there. Just to anybody out there that wants to ask a question, if you go to slido.com, hashtag GG2021, we're taking questions. We've got about 7 more minutes here with Arjun, so please let us know your property questions and what's important to you as business owners when it comes to property. Has anybody out there experienced some things that they would like to know from an investor point of view? So Arjun, tell us a little bit more about the process when someone gets involved in business, and especially if you're in business and it's your first time. What's the first thing that you should do when you're looking at investing?
I think the first thing that investors really need to consider is going back to even before property, it's the finance. Now, many investors, who are business owners, can get really happy again about that turnover in the business. But what about the leftover? What about paying yourself? What about that structure? So I feel even before property comes the accountant, comes finance, comes borrowing power. Your mortgage broker or banker will really play an important role. Once you've done that, this is where people can reach out to teams like ourselves, InvestorKit, and they can speak to us about strategies, starting their investment journey, what's happening across the markets. This is when you start getting into the property phase. But I've seen business owners who have had extremely successful ventures in business, and they now want to aggressively acquire wealth, and they've done it in their later periods of life. And then some people who've started young and just slowly chip away in each and every purchase where they can. But the beauty about investing whilst being a business owner is that each year you can have these goals. Each year you can reflect on your business, the income, its performance, reverse engineer the type of level of income you need to pay yourself, you need to have in the business with your broker to say, for you to get that next property, you'll need this in savings. So I feel all of that put together can help.
Yeah, great. So if you're a business owner out there, it sounds like you need a team. So build your team and find the experts so that you can make your wealth strategy and grow your own wealth using and leveraging your business. It is possible. So I encourage you all to find an expert to talk to. I'd love to say thank you to Arjun. You've been a wealth of knowledge. It's been lovely speaking with you, and we are glad that you were here.
Thank you.
So we have some amazing workshops coming up. With us, we have Rebecca Swanson, who is going to explain neuroscience and how getting off track each year with your goals and how you can stay on there with neuroscience. And Brian Doherty is how to structure the numbers in your business to work for you. So we'll just go to a short video, and then you'll be able to be going into those rooms and listening to your favourite speaker. Thank you.